There's a number that sits quietly in a spreadsheet somewhere in Basel, Switzerland. It doesn't make headlines. Most people have never heard of it. But if it drops below a certain threshold, banks start to collapse, credit freezes, and millions of people lose their jobs before they even know what hit them. That number is called the capital adequacy ratio. Right now, it's lower than you think. In 2008, Lehman Brothers had $25 billion in capital and $691 billion in assets. That sounds stable. That sounds like a fortress. But the math that mattered wasn't addition, it was division. And when you divide 25 by 691, you get 3.6%. That's how much actual money they had compared to how much they owed. When their assets lost just 4% of their value, the entire firm evaporated. This isn't a story about one bank. It's about a system designed to run on the thinnest possible margin, where a rounding error can trigger a cascade that destroys economies. And the uncomfortable truth is that most banks today operate with the same fragile math, just dressed up in better language. Let's start with what a bank actually does, stripped of all the jargon. You deposit $1,000. The bank doesn't lock it in a vault. It lends out 900 of it, maybe to someone buying a house, maybe to a business expanding. That loan becomes an asset on the bank's balance sheet. Your deposit becomes a liability. The difference, that $100 the bank kept, is capital. It's the cushion, the buffer, the thing that absorbs losses when loans go bad. Now here's where it gets strange. That $900 the bank lent out, it gets deposited in another bank. That bank lends out 810 of it, which gets deposited again and lent again. Your original $1,000 has now created several $1,000s of credit in the economy. This is called fractional reserve banking, and it's not a glitch, it's the feature. It's how modern economies grow. But it also means the entire system is built on a chain of promises, and promises break. In the 1930s, during the Great Depression, banks held around 15 to 20% capital. They were cautious, paranoid even. After thousands of banks failed, regulators decided that maybe, just maybe, banks should hold more of a cushion. But then something funny happened. Over the decades, as memory of the Depression faded, that cushion started shrinking. By the 1980s, capital ratios were down to around 6%. By the early 2000s, some of the biggest banks in the world were operating at 3 or 4%. They argued that they were sophisticated now. They had models, risk management, diversification. They were wrong. When the subprime mortgage market started to crack in 2007, banks didn't just lose money on bad loans. They lost money on securities backed by those loans, and on derivatives tied to those securities, and on insurance they sold against those derivatives. The losses compounded in ways the models never predicted, because the models assumed that housing prices wouldn't fall everywhere at once. But they did. Lehman Brothers went under in September 2008. Within days, credit markets froze. Companies that had nothing to do with mortgages couldn't borrow money to make payroll. The entire global financial system came within hours of a complete shutdown. Central banks had to inject trillions of dollars just to keep the lights on. And the villain of the story? That 3.6%. After 2008, regulators tried to fix this. They introduced something called Basel III, a set of international rules that required banks to hold more capital. The new minimum was set at around 7% for most banks, with additional buffers for the larger ones. It sounded like progress. But here's the twist. That 7% isn't measured against all assets. It's measured against something called risk-weighted assets. And banks get to help decide what's risky and what's not. Government bonds? Zero risk. Mortgages? Low risk. Corporate loans? Medium risk. The math gets adjusted, and suddenly a bank that looks like it has 10% capital might effectively be running at 4 or 5% if things go wrong. This isn't a conspiracy, it's an optimization. Banks are profit-maximizing machines, and capital is expensive. Every dollar held in reserve is a dollar that's not being lent out. not generating returns, not boosting quarterly earnings. So they push the boundaries, they innovate, they find ways to make the denominator smaller and the numerator look bigger. And regulators, who are often staffed by people who used to work at banks and will work at banks again, let them. In March 2023, Silicon Valley Bank collapsed in 48 hours. It had $209 billion in assets and about $16 billion in capital. That's 7.6%, right in line with regulations. But most of its assets were long-term government bonds, which are supposed to be safe. When interest rates rose, those bonds lost value fast. SVB's customers, who were mostly startups, panicked and tried to withdraw their money all at once. The bank didn't have it. Within a weekend, regulators seized the bank and depositors were made whole by emergency government action. 2 days later, Signature Bank failed, then First Republic. The contagion was spreading, and it took aggressive intervention to stop it. Silicon Valley Bank wasn't some reckless subprime lender. It followed the rules. It passed stress tests. It had a capital ratio that met regulatory standards. And it still collapsed. Because the ratio isn't a measure of safety, it's a measure of minimum acceptable fragility. Now, let's zoom out. The global banking system holds around $130 trillion in assets. If the average capital ratio is 8%, that means there's roughly $10 trillion in capital backing all of it. That sounds like a lot, until you realize that a 10% loss in asset values would wipe it out entirely. And in a crisis, asset values don't decline politely, they plunge. In 2008, US housing prices fell by about 30%. European banks, who were heavily invested in US mortgage securities, saw their capital evaporate. Ireland had to nationalize its entire banking system. Iceland's banks collapsed with debts worth 10 times the country's GDP. Greece needed multiple bailouts. Spain, Portugal, Italy all teetered on the edge. One little number, compounded across borders, brought the global economy to its knees. And we didn't fix it, we patched it. There's a debate in economics about what the right capital ratio should be. Some argue for 15%, others say 20 or even 30. The banks predictably say that's insane. They claim higher capital requirements would choke off lending, slow growth, kill jobs. But here's the thing. Switzerland requires its biggest banks to hold around 15% capital. Canada's banks held higher ratios going into 2008 and didn't need bailouts. Higher capital didn't destroy their economies, it stabilized them. The US could do the same, but it won't, because banks are politically powerful, and capital requirements are a quiet, technical policy that doesn't win elections. It's easier to deal with a crisis when it happens than to prevent one that hasn't happened yet. So we live in a system where the math is bad, everyone knows the math is bad, and we've all agreed to pretend it's fine until it isn't. There's a term for this in finance. It's called moral hazard. When you know you'll be bailed out, you take bigger risks. Banks lend more aggressively. They chase higher returns. They operate with thinner margins because they know if things go wrong, the government will step in. Taxpayers will absorb the losses. The system will be saved. And it works until it doesn't. Japan's banking crisis in the 1990s lasted a decade. Greece's economy contracted by 25% after 2008. Argentina has defaulted 9 times. These aren't hypotheticals. They're case studies in what happens when the math catches up. And the math always catches up. Right now, commercial real estate in the US is struggling. Office buildings are half empty. Valuations are dropping. Regional banks, which hold a lot of commercial real estate loans, are sitting on unrealized losses. If those losses become realized, if property values fall far enough, some of those banks will fail. The capital ratio won't save them. It'll just tell us after the fact that they were doomed all along. Here's the irony. The system is designed to be efficient, to allocate capital where it's needed, to fuel growth. And it does that. Credit is what builds factories.
funds startups, finances homes. Without it, modern economies don't function. But efficiency and stability are opposites. The more efficient the system, the less room for error. The less room for error, the more fragile it becomes. We've built an economy on the foundation of leverage, where every dollar of capital supports 10 or 15 or $20 of assets, and we act surprised when the foundation cracks. There's a question worth asking. How much risk are we willing to tolerate for how much growth? Because that's the trade-off. Higher capital ratios mean safer banks. They also mean less lending, slower growth, lower